All right, welcome to the deep dive. We do things a little differently here.
We do. We take the sources that you provide and cut straight to the stuff that you need to know.
It's like your cheat code to becoming seriously informed without the reading marathon.
Precisely. You know we love when you bring us some really interesting sources.
Yeah, this time you've sent us some excerpts from 098.pdf, which gives us a pretty rare peek behind the curtain of high finance.
Really fascinating stuff, specifically focusing on Bill Gross and the meteoric rise of PIMCO.
So, learner, our mission for this deep dive is to take these excerpts, dissect them, and extract the really key insights.
We want you to walk away with a solid grasp of PIMCO, their inner workings, and the whole financial landscape they were operating in.
And of course, we're going to keep it fun and jargon-free. You know we're all about those aha moments, the ones that reveal the human side of this whole financial world.
And the evolution of those market strategies, too.
Okay, ready to dive in?
Absolutely. Let's do it.
So these excerpts really start us off with Bill Gross, right? His early days, his initial dance with the bond market.
Yeah, back then, bonds were kind of seen as, well, buy and hold investments. You just sit on them.
Just clip those coupons.
Exactly.
Mhm.
But Gross, he had a different vision. After this kind of pivotal lunch with Howard Rakoff,
With his, what was it, his brown binder full of trading ideas.
that's the one. Gross got this idea. Actively trading bonds to generate returns.
Wow, talk about shaking things up.
Oh, totally. A huge departure from the norm.
So early on, it wasn't just about being a trading whiz. Client relationships were massive, right? And of course, the business smarts.
Absolutely. They had that three-pronged approach. It was all about balance.
Yeah, the book calls it the three-legged stool. You had Gross leading the charge on trading.
Then Muzzy was the client whisperer, amazing at building those crucial relationships.
And then Bill Podlich was their strategist, the brains behind the business side.
It was a winning formula, clearly.
And they snagged some seriously big clients early on, right? Like Southern California Edison, even AT&T.
Big names, for sure. And there was this legislation in '74, ERISA, that really changed the game.
How so?
Well, kind of formalized the whole money management industry, Suddenly there was this huge demand for their expertise. Corporate retirement funds, all that.
So regulatory change can really fuel growth in unexpected ways.
Oh, absolutely. It can be a huge catalyst.
But even in those early days, you can already sense this high-pressure environment brewing.
Definitely. The book even mentions that Bill Podlich ended up leaving because of the stress.
Wow, that says a lot.
It does. And his departure actually opened the door for Bill Thompson to step in. He came from Salomon Brothers in '93.
Salomon Brothers, they had that super aggressive, almost cutthroat culture, right?
That's right.
Right.
So you can kind of see how PIMCO's internal dynamics might have shifted even more towards that intense side.
Speaking of culture, the book doesn't hold back on what it was like at PIMCO under Gross.
No, it's pretty vivid. There's this description of a mock asshole exercise led by Bill Thompson.
An asshole exercise. What?
Yeah, it was this thing where employees were basically encouraged to let loose, be brutally honest with their opinions, no sugarcoating.
Wow, radical transparency taken to a whole new level.
Right. I mean, it really highlights their commitment to direct, even if it was kind of harsh, feedback.
It's fascinating how Gross's own personality kind of shines through these stories. He wasn't a big fan of traveling, much preferred to be glued to his Bloomberg terminal.
The ultimate data junkie.
Total focus. And you see this dynamic with Scott Simon, who had this strong reputation outside of PIMCO, and it seems like he was a little shielded from the typical PIMCO pressure cooker.
That suggests a pretty meritocratic environment. Perform, and you earn some leeway.
But make no mistake, the pressure to deliver was immense. There's this line that really captures it. Your ass was always on the line.
Oof. Yeah, past success didn't buy you much security there.
It makes you think how that constant pressure probably fueled both incredible innovation and some serious internal friction.
It's a double-edged sword, for sure.
And you can't talk about Gross without talking about the total return fund, right?
It was his baby. Absolutely. The culmination of his whole approach to bond trading.
And it wasn't just a fund, it was totally intertwined with his identity.
It was his legacy, his claim to the title of the Bond King.
And his performance, well, that was deeply personal to him.
No doubt about it. Now let's fast forward to the 2000s, the housing boom.
A time of exuberance, let's say.
Right. But PIMCO, they weren't oblivious to the risks bubbling under the surface.
They had that report, The Housing Project, came out in May 2006. Laid out the dangers pretty clearly.
Yeah.
Low interest rates, risky lending practices, the whole 9 yards.
Exactly. But here's the thing. Even when you see the risks coming, it doesn't always translate into immediate market-beating returns.
That's a tough lesson.
It is. What's really interesting is that PIMCO's internal warnings started even earlier. The
Yeah.
book brings in this guy, Paul McCulley, a brilliant economic mind at PIMCO.
Yeah, McCulley, he was sounding the alarm about the shadow banking system back in 2002.
Way ahead of the curve. He saw the interconnectedness of all these non-bank financial institutions, and he warned about a potential Minsky moment.
A Minsky moment. What's that?
It's the point where too much stability, ironically, leads to insane risk-taking and eventually collapse.
Ah, so it's not just about watching the traditional banks. You got to look at the whole system.
Exactly. Understanding those systemic risks is crucial.
So while everyone else was, as the book says, gorging on whisk.
PIMCO took a step back. They reduced their exposure to those risky bonds. They were cautious.
And Gross, he publicly stated in July 2006 that interest rates had peaked, basically signaling that the housing bubble party was coming to an end.
A bold move. It shows how they use their research, especially those investment outlooks by Gross, to try and shape market perceptions.
Those investment outlooks were something else. I mean, they weren't your typical dry financial reports.
I know, they were engaging, even entertaining, filled with personal stories, sometimes even poems.
Really? Poems.
Yeah, and humor, too. It was a brilliant way for Gross to connect with people, make those complex ideas stick.
So he was building a following, shaping the narrative.
Absolutely. But here's the catch. Being early, even if you're right, can hurt.
How so?
Well, those risky bonds, they kept rallying for a while.
Yeah.
PIMCO's cautious approach actually led to some short-term underperformance.
It's like that saying, the market can stay irrational longer than you can stay solvent.
Exactly. It highlights that constant tension between your convictions and the pressure of the market.
It's interesting how Gross's personal experiences kind of shaped his view on risk. The book talks about his summer counting cards in Vegas.
Blackjack, huh?
Yeah, he developed a system, learned from others' mistakes, really understood the discipline needed to stick to a strategy.
That's a valuable lesson no matter what you're doing.
It is. And that experience, it clearly influenced his approach to the financial markets. He was all about finding an edge through analysis and disciplined execution.
Sounds a lot like that card counting system.
Yeah.
Now let's talk about 2008, the financial crisis.
Things were getting pretty hairy. The book describes the whole escalation. Problems at Bear Stearns hedge funds, those credit spreads widening in July 2007.
It was a cascade of bad news.
And what's amazing is that during all this, Gross had a Panama Canal cruise planned.
He really valued his downtime, wanted complete separation from work on vacation.
Talk about dedication to unplugging.
Right. But this crisis, it was impossible to ignore. It spread like wildfire from subprime mortgages to quant funds.
Global impact.
Everywhere. The Fed had to step in. There was even talk of a super fund to bail out all those troubled assets.
Which ultimately didn't happen.
No. But what's really striking is that PIMCO's caution, it paid off. Big time. While others were taking massive hits, their total return fund was up over 9% by the end of the year.
Morningstar said they smoked their peer group. That's got to feel good.
It was a huge vindication of their strategy.
Back at PIMCO, though, the atmosphere was intense. They canceled holidays. Everyone was on edge. That feeling of, like the book says, the unthinkable was thinkable.
It was all hands on deck. The book highlights their use of derivatives, their internal BUM report, to manage all those bonds.
They even came up with this concept called lambda cash, right? A way to potentially juice returns in fixed income.
Yeah, that was innovative stuff.
Yeah.
It shows how crucial it is to have solid risk management and be able to adapt your strategy when a crisis hits.
And they made this huge bet on bonds backed by Fannie Mae and Freddie Mac.
Government-sponsored entities.
Right. Gross was convinced the government would ultimately back them, so he went all in, even publicly advocated for government intervention.
That was a gutsy call, based on his understanding of systemic importance.
If he was wrong, the downside would have been
Massive. And then, of course, came Lehman Brothers.
the collapse that sent shockwaves through the whole system.
It caused that money market fund, the reserve primary fund, to break the buck. Panic everywhere.
It was a mess. But in the middle of all this chaos, PIMCO actually played a really important role.
Yeah, the New York Fed picked them to manage the Commercial Paper Funding Facility, or CPFF, basically a giant program to stabilize those short-term funding markets.
So even private firms can become essential players in a government-led crisis response.
They can.
Yeah.
And Gross, at the time, he said something that really captures the moment. The opportunities are just enormous. This is the Super Bowl for money managers.
He saw the crisis as this chance to prove what PIMCO could do.
Capitalize on the chaos.
And after the worst of the crisis passed, we see the emergence of the new normal idea.
Gross introduced this in his keynote at the 2009 Morningstar Investment Conference.
His big argument was that the days of huge equity returns were over. Stocks would become more about income.
Yeah, more of a subordinated income vehicle was how he put it.
A new landscape. And this was also a time of change within PIMCO. Bill Thompson stepped down as CEO after 15 years.
And Mohamed El-Erian came back to the firm, this time as co-CEO and co-CIO.
A new era for PIMCO. And one of the things they tried to do in this new era was push into equities.
Yeah, kind of surprising, right? PIMCO, the bond kings, wanting to play the stock market.
It seems Gross was really keen on expanding their reach. They even hired Neil Kashkari, the guy who was a big deal in the TARP program.
Head of new investment initiatives.
But the book suggests this whole equity push faced some serious internal roadblocks, didn't really pan out.
It seems like PIMCO's heart just wasn't in it. Their core expertise, their culture, it was all about bonds.
They had that stocks plus strategy, which used derivatives to get some exposure to equity returns.
But it was still fundamentally a bond-centric approach.
And Gross, he had his own strategies like selling volatility, which the book compares to his blackjack bets, calculated risks within certain boundaries.
He was a master of that fixed income mindset.
Now, the book really doesn't shy away from describing the sheer power and influence that PIMCO had at this point. They would put Wall Street banks in the penalty box if they felt wronged in a deal.
No business for you.
They were a force to be reckoned with. Their trading volume gave them massive leverage.
But that aggressive culture, it might have had some unintended consequences, making some employees less adaptable to other environments later on.
A double-edged sword.
Definitely. And the book gives us some fascinating examples of PIMCO's trading strategies. Some innovative, some a little controversial.
Like that Ginnie Mae CDR futures trade, right?
The one dreamt up by Chris Dialinas. He spotted this tiny flaw in the futures contract.
A flaw related to how mortgage prepayments were factored in.
It was a technical nuance that most people missed.
But Dialinas, he saw an opportunity.
And it was a complex trade to pull off. They had to convince their clients, who were mostly pretty conservative, to get on board with this intricate derivative strategy.
Lots of trust involved.
Definitely. They built their position carefully, basically cornered the market. Eventually, the other players caught on.
But by then, PIMCO was already in a strong position and made a pretty penny.
It shows the importance of educating your clients, especially when you're doing something complex.
Absolutely. And this whole trade, it cemented PIMCO's rep as being scary smart.
They were the best at spotting and exploiting those market inefficiencies.
And then there was the launch of the PIMCO Total Return ETF.
Gross framed it as a way to make PIMCO accessible to smaller investors, addressing those high investment minimums.
Democratizing investing. But the book points out that PIMCO already had funds with lower entry points.
They did. And it's funny, even though Gross had written a whole book advocating for low fees back in '97, PIMCO's sales team wasn't exactly jumping up and down to promote the ETF.
Interesting. And there were also regulatory hurdles, right? The ETF couldn't use derivatives and cross-trading as freely as the mutual fund could.
Yeah, those rules can be tricky.
So, to boost the ETF's performance, Gross used the strategy of buying cheap, odd lots of non-agency, mortgage-backed securities.
Plus, they had this guy, Pat Fisher, who was a master of executing trades efficiently.
So the ETF ended up outperforming the very mutual fund it was supposed to mirror.
A bit awkward, to say the least. It raised questions about whether they were favoring the ETF at the expense of the other funds.
They had to walk a tightrope with how they communicated about that.
Definitely. Now, by 2012, PIMCO was managing almost $2 trillion. That kind of scale. Well, people started asking if they were getting too big.
Too big to function was the phrase.
And after Dodd-Frank, regulators were really focused on those systemically important financial institutions, those sci-fis.
PIMCO didn't want that label. It meant more oversight, possibly even restrictions on their trading.
Not ideal. Internally, things were also shifting. They introduced these M units or M shares as part of a new incentive plan for newer employees.
That was after the Allianz acquisition, right?
Right. And remember that big push into equities we talked about? Well, it seems like Neil Kashkari, the guy they brought in to lead it, he was never really set up for success.
The book hints at that.
It does, and we see Dan Ivesteen's star rising. His Bravo fund was doing really well after the crisis.
It's implied that this might have created some tension with Gross. Sharing the spotlight wasn't really his thing.
Not really. And then there was the high-yield group at PIMCO, led by Ben Trotsky, which seemed to be a constant source of internal drama.
The book also mentions some legal issues that tropped up. A lawsuit from Jason Williams, who alleged misconduct with how they were valuing securities.
And a class action lawsuit stemming from this 2005 Treasury futures contract thing. They were accused of market manipulation.
Operating at that level, you're always under a microscope.
Always. Now, around this time, we start to see a change in Gross's tone, especially in his public pronouncements. In his April investment outlook, he gets really introspective. Asks, am I a great investor? No, not yet.
Wow, a moment of self-doubt from the Bond King.
It seems so. He even mentions Peter Lynch, the guy who famously retired early.
Maybe he was starting to think about his own legacy, his next chapter.
Possibly. And the underperformance of the Global Multi-Asset Fund, the GMAF, was adding to the pressure.
That's the one Ellery got more involved with, right?
Yeah. The book also reveals this fascinating detail about Gross.
Mm-hmm.
He was doing a lot of anonymous charitable giving, inspired by that old TV show, The Millionaire.
Interesting. Maybe a way of reconciling his immense wealth, his impact on the world.
Could be. And his views on labor were evolving too, which had implications for PIMCO's whole compensation model.
And all this time, there was this looming question of succession planning. Who would take over after Gross?
It was a source of uncertainty and tension. The book describes a particular investment committee meeting where Gross and Ellery clashed over risk allocation.
Philosophical differences coming to a head.
Exactly. And then there was the rise of those unconstrained or go-anywhere funds.
PIMCO's own unconstrained fund, the one managed by Chris Dialenis, wasn't doing too well.
Gross ended up taking it over, which was seen as a direct snub to Dialenis. He ended up announcing a sabbatical.
And then other key people started leaving too.
It was like a slow-motion exodus.
Right.
And then, in January 2014, Mohamed El-Erian resigned.
Publicly, he cited family reasons.
But everyone knew that there was more to the story.
The book, and some reporting that came out later, suggested that the friction with Gross was a major factor.
A big factor.
At first, Gross tried to downplay any conflict in interviews.
But then the Wall Street Journal dropped this bombshell article. It described a showdown and painted Gross as a really difficult personality.
Gave a lot of examples, like he would use silence on the trading floor as a way to reprimand people.
Weird power move.
And he was obsessed with precise page numbering in documents, would get really angry if things weren't just so.
Control freak tendencies.
And when people would give presentations, he would just say more of it if he didn't like what he was hearing.
Not exactly constructive feedback.
And there was this one incident where he made this guy, Brynolfsson, stand up during a presentation.
Just to make a point.
It was humiliating. Gross went on CNBC and denied everything in the journal article.
Vehemently.
But the damage was done. Rumors started swirling about clients getting nervous, pension consultants putting PIMCO on their watch lists.
Not a good sign. And the journal also highlighted Gross's massive compensation. Over $200 million a year.
It fed into this narrative of him being this unchecked, powerful figure.
It did. And Gross seemed fixated on El-Erian's departure. He even accused Jennifer Abolin at Reuters of bias in her reporting.
They couldn't let it go.
No. And internally at PIMCO, people were not happy with how he was handling things in the media. It created a really tense atmosphere.
El-Erian's farewell party even got postponed because of it.
Wow. And Morningstar actually downgraded PIMCO's stewardship grade.
A public rebuke.
Definitely. And then there was the SEC investigation into PIMCO's bond valuation practices, plus an internal investigation because of a complaint by Thyman.
So a lot of scrutiny.
A lot. And the book suggests that after El-Erian left, Gross kind of turned his attention to other senior figures within PIMCO.
He needed a target for his frustration.
Seems like it.
Hmm.
And Hodge, he actually warned Gross that he could be held accountable for his behavior.
Things were getting serious.
They were. So in March 2014, Gross went on this kind of media tour, trying to control the narrative.
There was that big Bloomberg Business Week cover story where he talked about his morning routine in detail.
It was pretty eccentric.
He tried to present this image of a happy family of deputies, downplayed any conflict, even dismissed the reports about his temper as sort of silly.
Damage control.
But clients were still pulling money out of PIMCO's funds, and El-Erian, when he talked about his departure, he was always very diplomatic.
A stark contrast.
And PIMCO was trying to push this new neutral thesis on interest rate.
Their new investment strategy.
There were rumors about them making this huge S&P Strangler options trade.
Risky.
And they moved into this massive new building in Newport Beach.
But even with Paul McCulley still publicly supporting Gross and PIMCO,
Internally, people were getting worried.
Gross's investment outlooks were getting really weird
Like talking about dead cats and sneezing.
and saying he didn't have a cell phone.
It was bizarre.
It was. And there were these awkward attempts to publicly support Gross from within PIMCO.
Like Hodge writing this super gushy viewpoint.
It all felt very forced. And then there was this explosive meeting where Gross just blew up at Hodge and others.
A breaking point.
It seems like it. Maybe that's when Gross realized that his power wasn't absolute.
There was a meeting after that, though, which was apparently more productive.
Some accounts suggest that Gross even proposed stepping back from his role as CIO.
So maybe he was starting to see the writing on the wall.
Maybe. It's interesting how, despite being this dominant public figure, Gross actually struggled with social interactions on a personal level.
The book talks about how he was really anxious about going to his high school reunion.
Kind of ironic. And then came the phone call that no one saw coming. Gross called Jeffrey Gundlach,
The guy from Double Line Capital.
his arch-rival.
Wow. Gundlach himself had a pretty messy exit from TCW years earlier.
He did. So Gross basically pours his heart out to Gundlach, talks about all his grievances, even hints that he'd be willing to work for practically nothing.
Desperate time.
He even mentions the SEC investigation.
But Gundlach, he lays down the law. No shared leadership.
No way. And there were regulatory concerns too, right? About what would happen if Gross, the bond king, suddenly jumped ship.
Systemic risk.
Exactly. So Alliance, PIMCO's parent company, they were scrambling to keep the other key people at PIMCO.
Stop the bleeding.
Right. And here's the kicker. After Gross left, the Total Return Fund actually started performing better.
Ouch.
Gross called his move to Janus a divorce. He was determined to prove he could still be relevant.
That first investment outlook he put out at Janus was, well, classic Gross.
Full of those strange personal touches.
And after Gross left, Maisonneuve also left PIMCO, which further impacted their diversity.
Then, in August 2015, the SEC officially issued a Wells notice to PIMCO.
The hammer was coming down.
It was. And Gross always believed that his populist views and other people wanting a piece of PIMCO's profits led to his downfall.
He even wrote this whole 31-page mini-memoir about it.
Couldn't let it go. And then, in November 2016, Sue Gross filed for divorce.
Which turned into a really messy public battle.
It did. The book ends by reflecting on Gross's life now. He remarried to Amy Schwartz and seems to be finding happiness in giving back.
He always had that ability to reinvent himself.
He did. There's even this little anecdote about someone thanking him for his past investment management, a brief moment of recognition.
A reminder of his impact.
So, learner, after this deep dive into Bill Gross and PIMCO, what have we learned?
We've seen the birth of active bond trading, the rise of this intensely demanding culture under Gross, their navigation of those massive financial crises.
We've seen the internal power struggles, the conflicts, and ultimately the dramatic exit of the founder.
And I think the biggest takeaway is that even in the world of finance, with all the numbers and data,
It's the human element that really drives things.
it's a story about brilliance, eccentricity, that constant push and pull between innovation and risk.
All under immense pressure with huge stakes.
So we leave you with this question. How do you think the personalities, the internal dynamics within an organization, even one as big and powerful as PIMCO,
How do they shape its fate, its vulnerability to disruption?
what about other industries, other organizations you know? Can you see those same patterns playing out?
It really shows that even in the seemingly objective world of high finance, the human factor is the most powerful force of all.
And that's the deep dive for this time.
See you next time, learner.
Until then, keep diving.